Live from New York City this morning. Good morning, good morning. Coming up this afternoon, a big day for big tech. From New York, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, big tech earnings kicking off.
It's not a great backdrop right now.
The Fed's hawkishness is really driving bond yields higher.
We've had a tremendous backup in yields.
You've got all the overhang of what's happening in China.
This is really challenging those big tech companies.
It's become very tough right now.
Overall, the ad checks have been mediocre.
You've certainly seen the market take out pretty significantly companies like Facebook or Netflix.
In terms of negatives, it's Meta, Facebook.
Facebook has a very difficult comp.
Bullishness, I think significantly better in the street would be Microsoft on the cloud story. I think Apple is another one. I think Google.
The good news is a lot of these stocks have been hit really hard.
Ultimately, the question is going to be
which companies are going to be able to defend their margins.
That's really where the attention needs to be focused on.
Joining us now to discuss is Nuveen's Rudnick and Julie Biel of Kayne Rudnick. Julie, first to you. How important is this week for earnings?
It's a pretty critical week. I think people are trying to understand how the impact of higher costs is rippling through the tech sector, how are companies deciding to spend, what's going on in terms of valuations for M&A. A lot of these businesses are just so large, it's getting harder and harder for them to find good quality growth. So I think understanding that and profitability will be the key to understanding this quarter.
Brian, to what extent do you think we're underestimating the resilience of some of these big names?
I think we probably are, but at the same time, you saw in the first quarter and through April that every time we get sort of this sharp, borderline disorderly rise in interest rates, a lot of these companies' shares get killed. So I think we may be having to live in sort of this macro-driven world right now where individual company earnings look quite solid. We got a very good durable goods number just now. I think we'll see a very strong software investment component in the first quarter GDP number later this week. But that's not helping the share prices right now. What would help the share prices for inflation to be a little bit lower and for some of the rate concerns to start to ebb away.
Well, that's what I want to build on. This month has been absolutely terrible for the Nasdaq 100, down almost 9 percentage points through the month of April so far. Lori Calvasina over at RBC is trimming her outlook on US equities to 50.50, from that to 48.60. The recent move up in bond yields was the biggest contributor to the downward revision to our forecast. The words there of Lori Calvasina. So, Julie, to come to you, how much of this move in the Nasdaq this year has been about reassessing the earnings of these big companies, and how much of it has been just a read across from what's happening in the bond market?
I think most of it really has been driven based on valuations, right? The fundamentals of most of these businesses, other than, let's say, Netflix, have been actually quite positive. But, I think we look at the rise in big tech earnings that had been driving so much of the S&P, and we tend as human beings to assume that the higher prices are the right prices. But frankly, the correction is actually just bringing things back to normal. The valuations had reached so far beyond what was normal for historical trading ranges. We're really just getting to a place now where we can focus more on the earnings because the valuations leave less at stake.
Tons of earnings coming up after the close. Alphabet and Microsoft tomorrow, Facebook, then on to Apple and Amazon. More than a third of the S&P 500 reporting results this week, and about 40% of the Nasdaq 100 reporting this week in just 5 names. Katie Lai, some big figures.
Yeah, absolutely. A casual, $8.5 trillion in market cap across just these 5 companies. So clearly, these results will matter a lot, not just for their share prices, but really that of the broader equity market. These are big influences. Now, I would note on the broader equity market, we have seen earning estimates getting stronger over the last month or so. While at the start of March, we were only expecting growth of 5.1%. Now those have been ratcheted up to 6.9%, helped out by the fact that about 80% of the companies that have reported thus far have topped estimates. But for big tech, the bar is going to be pretty high. They have a lot to prove here, especially because they are so beaten up going into the prints. For Microsoft, of course, the focus will be on that Azure cloud business. For Alphabet, advertising revenue from search and YouTube are really going to be key. But can it turn things around is really the question. When you're looking at Alphabet here, for example, it's on pace for its worst month since March 2020, down more than 11% in April so far, wiping out more than $200 billion in market capitalization over just a couple of weeks. Microsoft has seen almost the same amount knocked off as well. And when you add all the mega caps together, they've collectively seen $884 billion in market value eviscerated in the month of April. That represents about 54% of the decline we've seen in the NASDAQ 100 this month, John.
Kelly Nice, thank you. It's been brutal. So what would it take for these names to start performing again? What would bring some comfort to the NASDAQ 100? David Costin of Goldman said this: the resumption of sustained growth stock outperformance will require equity investors to gain confidence that the economy will slow but avoid recession, and that inflation will soften enough to reduce the need for further tightening. Such an outcome, he says, is possible, but investors are skeptical the Fed can achieve both goals without causing a recession in 23. Judy, can you build on some of this from David Costin over at Goldman? What would bring the NASDAQ some comfort, and how elusive might that comfort be this year?
I think people are heavily fixated on where rates are going to be, and the Fed does have a very difficult job right now. What it really needs to do, right, because supply is pretty fixed, and supply chain challenges are only going to get harder with all the shutdowns that are happening in China. So supply's fixed. The real question is, can it pull down demand enough to slow down and meet supply demand so we have less inflation, but not so much that we tip into recession? And I think that's going to be challenging, right, because for our year-over-year comparisons, we're losing out the positive impacts of the stimulus. So it's hard to know whether the consumer is going to be as resilient as we would like. The consumer is now actually having to buy gas at higher prices, drive to work now. So I think it's a really murky environment to know how to slow down the consumer enough, but not too much. For big tech, I think that the focus needs to be on the fundamentals. And a lot of these businesses have corrected pretty materially, but it shouldn't matter that much for the large cap tech names, right? Because they don't have long earnings duration. They have real earnings right now. They have 90% market share. It says everything that Halliburton and Google are trading at similar multiples. I'd rather own Google personally.
Brian, can you speak to that? Just this relationship that a lot of people talk up between what's happening with rates and what's happening with the valuations of these companies?
I think a lot of it is about the terminal rate. I think we all have to get used to and comfortable with the idea that the Fed's going to be going very quickly back to neutral, whatever they deem that to be, 2.25%, 2.5%, maybe a bit higher. I think once we get the June dots, getting back to that level of rates by the end of the year, I think is going to be something that investors have to get comfortable with. The question is going to be, is the Fed going to 3.5%, 4%? And do we continue sort of this vertical rise in expectations for where rates are going to be in 23 and 24? And that's what's really troubled tech. So a couple of negative misses on inflation, a couple of positive surprises on labor force participation, I think probably takes us out of that worst case scenario wage price spiral situation. And that probably gives a lot more comfort to tech.
Judy, would you agree with that? Would that be sufficient to move away from what's been described as a mechanical peak in inflation?
Yeah, I think that's going to calm people down if we start ratcheting down. But again, it's, you can't talk about technology as a monolith, right? There are some of these businesses that are extremely durable, extremely strong, and they're trading at very reasonable multiples. And there are ones like, the snowflakes and some of the EV companies that have just gotten way out over their skis. And so I think what we're going to see is a little bit of differentiation in terms of the quality of these businesses relative to their valuations.
Judy, have you been spooked by, say, a big move on Netflix, a heavily research company like Netflix being that out of sync between the market and market participants and the fundamentals, the numbers they deliver?
Well, I think what's interesting is how quickly investors have come out of technology, right? And so I think it makes sense that a business that underperforms quite as materially as it did causes people to really run for the exits. I think we'll see more of these negative earnings surprises going forward, but if you find businesses that you think have more durability, and I would guess those are the ones that have less exposure to the U.S. consumer, because to me, that's the real black box.
Brian, just add to that, just briefly, just that story on Netflix. Did you learn anything there? Was that a single Netflix story or something for the broader market for us to think about?
I think it's something broader. I think a lot of us missed just how quickly consumers would adapt to the pandemic on the way in, and how quickly habits change, how quickly the pattern of consumption changed from services to goods, but a lot of these online streamers as well. And then I think we may also have underestimated and continue to underestimate the trajectory of the shift in demand back to something that looks more like normal. So if people are going to be going out traveling more, staying at hotels, taking vacations, they may be doing a little bit less of staying home and watching streaming TV.
Brian, Nick, Judy, Biel, sticking with us. The airline numbers have been phenomenal over the last week. Let's get you some movers going into the opening bell. is Taylor Riggs.
John, taking a look at, well, maybe some of that reopening trade, right? Because we're taking a look first at shares of UPS, maybe saying that they'll be shipping fewer items because maybe we're actually now all going outside. Nonetheless, though, the numbers frankly looked really good, raising those prices. This is a company with pricing power, beating estimates across the board, and analysts really liking that they are reaffirming that 2022 guidance. GE is a really good bellwether on the economy as well. They, John, are highlighting that 2022 profit guidance will be near the lower end of the forecast because of supply chain issues. And that is also the theme of Polaris there as well. You know them as the manufacturer of on and off-road vehicles. Again, citing supply chain issues. Analysts said that first quarter was weak entirely because of that problem. Finally, Twitter. Now, maybe no big news overnight, but we went wall to wall yesterday after pretty much the closing bell when that news broke right before 3 p.m. We will still get those quarterly results Thursday, but no conference call. Desperate for more information, John, about the future leadership now of this company.
What was the reaction to the fact that they're not doing an earnings call from the people you spoke to, Taylor?
Analysts said entirely irrelevant now, and shows how weak this board is, that this deal happened so quickly, that there were no other buyers, no white knight, and they handed it over.
Does it offer a sneak peek as to what those earnings might be?
Well, a lot of the analysts actually talked about Snap, who had lowered and guided lower for the future, and said that that actually might be indicative of a little bit of a weak advertising company. Not one analyst said that this was an undervalued company at $54.20.
Taylor Riggs, thank you. Good to catch up. Taylor with us into the opening bell. Coming up, China grappling with the implications of its COVID-0 policy.
We're continuing with our long-term plans to grow our wealth franchise. No reason to slow it down, despite some short-term dislocation. But overall, we remain big China bulls.
That conversation up next.
I think we're continuing with our long-term plans to grow our wealth franchise there. We see no reason to slow it down, despite some short-term dislocation because of the Omicron variant. But overall, we remain big China bulls.
He's bullish. He's got to be. That was HSBC. China's central bank looking to ease investor concerns, pledging to boost its economy, saying the following. The PBOC will step up the prudent monetary policy support to the real economy. Joining us now is Damien Sassower of Bloomberg Intelligence. Damien, we're used to this. That kind of line gets pushed out when these kind of things happen. What are they going to do?
Promises, Jonathan. I mean, it's been all about small business and assistance for big technology. And now what we're looking for ahead of hopefully the Politburo meeting, which is supposed to happen at the end of this month, is a little bit more of a focus on households. We've been providing tax incentives and tax cuts, but what they need is subsidies. They need hard cash. And it's also about the property sector. We know there are $90 billion of debt payments that are due between now and the end of the year by private property developers in China. They're going to need some help in order to make those payments, Jonathan. And I think those are the real risks heading into this month's Politburo meeting. And also, coming up next week, we're going to see some PMI data that is going to be absolutely abysmal. We'll probably see the official manufacturing at something on the order of, 44, and the non-man probably on something like 37, 38. The pretty big declines from where we were just last month.
This is breathing some life into the currency pair that is dollar yuan.
Yeah.
I mean, that didn't happen last year. Yeah. There was just immense stability, and you and I would talk about it. Lockdowns, COVID-0, economic weakness, currency stability. This time, no. The last week, something's changed, Damien. What changed?
Well, they slashed the RRR rate, the FX RRR rate for big banks. So look, that does not change the direction of activity. So you can expect the yuan to depreciate that much more. The PBOC had hiked the FX RRR rate twice last year. It never changed the direction. It only kind of slowed it. It slowed the trend. So we expect more of the same. We expect maybe the depreciation of the yuan to slow maybe in the near term. But the direction is there, and certainly if you look at U.S.-China yield differentials, which obviously the FX pair tracks very, very closely, Jonathan, it's pointing lower.
Damien, the damage to this economy and how it bleeds out to the rest of the world. Can you help me understand the nature of these lockdowns as they spread from Shanghai to Beijing? What are they like compared to what we witnessed maybe 18 months, 2 years ago? How different are they? And is this an economy still functioning in a large way?
Well, you have to look at mobility data. I mean, you really just don't have much else to shake a stick at, Jonathan. So if you look at, for example, Baidu mobility data, I mean, traffic in peak traffic hours in Shanghai are running at roughly 40% lower year over year. If you look at the two main airports in Shanghai, right, capacity is running at below 10% what it's used to. So, you know, you see that mobility is lagging. You see activity in the ports and logistics. So it's just really, it's really not good. And look, we can expect more of the same now with lockdowns spreading to Beijing, right? So I think, you know, it's a recipe for continued downgrades. We've seen GDP downgrades across the board. It began last week with Nomura, as you rightly pointed out. Now we've seen Morgan Stanley, Daiwa, TD, UBS. Everyone's kind of crowding in here, calling for low 4%, and Beijing is targeting 5.5% GDP growth for the full year of 2022.
Damien, you and I have gone back and forth on this. Just finally, this has largely been ignored by DM for the last several weeks, even though it's been clearly developing for a while now. Why do you think that was?
Well, I think, you know, you can't ignore it anymore. And I think the reason it's in the spotlight is because of the move in the Japanese yen, which you had alluded to many, many times in the last few weeks. And so for me, what does that do? It makes Japanese exports more attractive offshore relative to Chinese and Korean exports. I'm talking about when the Japanese yen depreciates to the extent it has. And so, I mean, this was inevitable that China had to reduce the yuan. It had to depreciate it somewhat just to make its exports that much more competitive. And I think that's what we're seeing here today.
Damien, awesome, as always. Damien Sasser there of Bloomberg Intelligence. Brian, Nick, just first to you, sir. We're starting to take notice of something really, really important developing in China. I'm just wondering how it factors into your outlook at the moment.
Something Damien said there at the end, I think, is really key. If you look at the March data for China, it's clear that they're prioritizing the export-driven industries. So the manufacturing and exports, we have all seen that kind of horrific graphic with all the ships, the container ships sitting outside of Shanghai because of lockdowns. But for the most part, in March, at least in the outset of this, it was clear that the policymakers in China were prioritizing manufacturing and export-driven manufacturing. And that, I think, is consistent with weakening the yen. It's the domestic economy that I think is the much greater concern. So if you're exposed broadly to Chinese equities, domestically driven economic growth, I think you have a lot more to worry about than if you're more exposed to those export sectors. But I think, to Damien's point as well, the broad-based decline in the PMIs and the overall rate of growth for April and perhaps beyond is going to be shocking.
Brian, have you got a decent understanding of how, say, the Federal Reserve or the ECB would internalize what's happening in China and express it through policy?
This is what makes it so tricky. It has almost, what's happening in China has almost nothing to do with the war in Ukraine, except in this one respect, is that it seems to present upside risk to inflation at the same time it presents downside risk to growth. So if you're a central bank, the tightrope you were already walking on probably got raised a couple of feet and is probably now a little bit thinner. How do you negotiate what should be somewhat transitory, and I'll risk using that word, increases in prices because of supply shocks, at the same time as you know that this is also going to have an overall negative impact on global growth and perhaps specifically on domestic growth if we're talking about Europe and the US, and how you negotiate those. And we're seeing it happen live in the markets. How you negotiate the likelihood of higher interest rates with the likelihood of somewhat weaker economic growth is the big trick, and that's why we've seen everything performing so poorly year to date.
It gets really confusing, and it gets confusing quickly. Peter Chatwell of Mizuho said this: the risk of further disruption of the Chinese economy means the Fed and ECB stay on aggressive tightening paths and into an even softer period of global growth. This is an extremely challenging environment for equity valuations. Julie, Biel, we've had some weakness into the energy names just the last 3 days. Julie, they've had a massive run over the last year. What do you do with those names now?
You know, I think energy in general is a very difficult place to do any kind of investing because you're really at the mercy of what world leaders are going to be doing. So, you know, for us as long-term investors, it hasn't been a space that we've been very focused on, but I think it's meaningful to see how those valuations have started to come in as people are starting to be more concerned about global growth expectations. And I think it's very meaningful for the US consumer to think about what percentage and share of wallet is going to be for oil and gas. I think writ large, I'm pretty enthusiastic about focusing on quality businesses that don't have this kind of commodity exposure that can be the, you know, focus on their own destinies. But, you know, it's a difficult environment for trading energy right now.
Julie, those names that you just mentioned, where are you finding them?
You know, we continue to like some of the smaller vertically focused tech names. Those are the ones that are serving the enterprise or business because we think they're going to be more resilient in the face of slowing growth. I wouldn't be completely out of growth writ large, right? Because in a slowing economy, that growth tends to outperform value. And, you know, growth is pretty out of favor. So I think it's an interesting sector to be looking at if you're finding quality names that actually have durable earnings. That's really the key.
Rudnick, just final word from you, sir. A final word on energy, if you can.
Sure. I think in the environment that we're in right now, status quo, hot economy, rates with an upward bias, energy is going to continue to be one of the outperforming sectors, subject to geopolitical risk as well, which seems to be keeping a somewhat positive risk premium on oil. I agree. Going forward, if we think we're going to be decelerating into either a Goldilocks-ish soft landing or something worse, energy is not likely to be the top performer or the top half of performers in that scenario. So we'd favor kind of positioning for that rotation into growth as well.
The key question there, what are we decelerating into? That's where the debate is. Brian, Nick, Julie, Biel, to the both of you. Brian, Julie, thank you. We heard from the German economy minister a little bit earlier on, speaking to reporters, actually in Warsaw, saying the following, that we're very close to independence from Russian crude. An embargo on Russian oil is now manageable for Germany. What happens there is going to be interesting as well. Coming up in the morning calls and later, we'll speak to Dan Ives of Wedbush as he says the Twitter soap opera is coming to an end. From New York City this morning, good morning to you all. Equity futures shaping up as follows on the S&P 500. Slightly negative, down almost 30. We are negative this morning, 0.7%. Your opening bow is just around the corner. 5 minutes away from the opening bell in New York City this morning. Good morning. Just a little bit of weakness creeping in. Going into earnings later, the Nasdaq down about 0.7%. The S&P 500 snapping the losing streak yesterday. That weakness returns down around about 0.2%. At the moment, the story in the bond market for a third straight session, yields lower. Looking at that move on a 10-year by 8 basis points lower to 274.15. At the front end too, we chop some of that yield down by 8 basis points or so to 254. That's the price action of the moment. Here are the morning calls. Raymond James downgrading Zions Bancorp to market perform, pointing to pricing headwinds and a lack of positive catalysts. We're negative there by 4.6% to 58.28. Next up, Susquehanna upgrading JB Hunt to positive, 217 price target, expected to see double-digit earnings growth over the next year. That stock is higher by 1.6%. And finally, Stifel upgrading Twitter to hold, viewing Elon Musk's takeover deal as the most likely outcome. At this point, to state the obvious, we're down about 1/3% here at 51.55, just short of the offer, the agreed price of 54.20. Coming up, the Twitter soap opera is ending, and our next guest doesn't expect any regulatory hurdles getting in the way. Dan Ives of Wedbush joins us next. 24 seconds away from the opening bell in New York City this morning. Good morning. Here's the price action. A snap back yesterday and then a snap lower again, down 0.6 on the S&P. On the Nasdaq 100, about 17% of the index reporting later in just two names. We'll hear from Alphabet and Microsoft too. We are negative there by 0.7%. There's the opening bell. Switch up the board and get to the bond market for a third straight session. Yields heading lower by a chunky 8 basis points to 274.34. The euro negative, a weaker euro, 106.82. A 106 handle. Remember the lows of late 2016, early 2017, a 103 handle. We're getting there. I would argue that back then, that was a goal of the ECB to get a weaker euro. I'd argue this time, that complicates things with inflation creeping ever higher. We're negative there, 1/3%. Crude back to 100 on WTI, up by 1.55%. That's the cross-asset price action. We're just a little bit softer, lower negative in the early part of today. Let's get you some movers. Here's Candy Lines.
Well, and it is a big earnings day as well, John. A lot of those movers at play here, and a lot of them tying back to the inflation and higher prices story. There are some beneficiaries of that, specifically those companies tied to the commodities and raw material space, including Archer's Daniels Midland, which, of course, is one of the world's biggest agricultural traders and processors. It handily beat expectations and announced its most profitable quarter ever, helped by strained supplies within the agriculture market due to drought, war in Ukraine. It's up 5.5% at the opening bell. Then on the oil side, you have Valero reported basically double the refining margins from a year ago, highest level since 2015. That stock is up about 0.9%. But companies face headwinds from higher prices as well. Whirlpool is one example. Those inflationary forces leading to a cut for both its earnings and revenue outlook. However, there is some optimism in the stock today, up nearly 5% on a strategic review of its EMEA business. And finally, Universal Health Services. This is an issue with higher labor costs. That led to an earnings miss, the stock getting punished as a result, down nearly 11% at the opening bell, John.
Kelly Nice, thank you. One more stock to watch, of course, is Twitter, negative about 0.7%, trading in and around 51.30. Looking at this, of course, on the West Coast, Ed Ludlow. Morning, Ed.
Good morning, John. Elon Musk has his deal to buy Twitter and take the company private for $44 billion. He'll give an investor $54.20 for each share that they hold. Transaction to close by the end of this year, unanimously backed by Twitter's board. Last night in an all-hands, Twitter's chairman, Brett Taylor, told employees, according to sources, that he'd done his fiduciary duty. $54.20 per share in cash. If you were an early investor in Twitter, you bought on the opening day of trading, October 2013, where the stock opened around $45, you're looking at a compound annual growth rate of around 2%. In other words, you made about $9 a share over the last 9 years or so. Not much to go off, right, if you've been holding the stock for that long. Then you look at the financing, $25.5 billion of debt confirmed in the statement, $12.5 billion in the form of a margin loan. The big remaining question is the $21 billion portion that's in equity financing. The Musk mystery, where does he get the cash? Now this is more friendly as opposed to a hostile takeover. Could we see private equity come in? Musk has talked about wanting to retain as many of the existing shareholders as he can. Could he roll some of those shares into the private entity? Or perhaps he sells down some of his Tesla stake or even some of his crypto holdings. Those are kind of theories on the table, John, of how we move forward. But ultimately, the statement said that the deal was between Twitter and an entity wholly owned by Musk, no co-investors on the equity portion of that financing.
Ed, what have we learned about breakup fees and the sort?
Yeah, so exactly. If Elon Musk walks away, according to sources, he will have to pay Twitter a breakup fee. We don't know what the amount is that's agreed in certain terms of the terms of that fee. The other thing is that there is not a go shop clause, right? Twitter cannot solicit bids from other bidders while this process is going on, while the transaction's pending close before the end of the year.
Ed Ludlow, thank you, buddy, as always. Dan Ives has this to say over at Wedbush. It all came down to no other bidders or white knights emerging in the M&A process, and Twitter's board back was against the wall. Once Musk detailed his $46 billion in financing last week to get pen to paper on this deal, Dan joins us now. If the team in the control room could just bring up the financing again of this particular deal, and you and I can go through some of the numbers together. And Elon Musk on the equity side of things, where's this cash coming from? Dan, have you got a decent read on this, that $21 billion in cash that needs to be raised?
Yeah, so that 21 billion, like you and Ed talked about, I mean, some of it could come from private equity or brings a partner in. Otherwise, that would be Tesla shares. Now, if you go back to that, that would be roughly about 12-15% of his ownership of Tesla. But importantly, those shares are not sold. Those shares are basically collateralized for a certain time period. Some portion could eventually be sold. But ultimately, this is really him, like we talked about, it's trading a portion of his Tesla shares to buy Twitter. And of course, the collateralized loan piece as well.
That piece you're comfortable with. Now walk me through the loans. Have we got a good idea of the interest on those loans, Dan? And if so, what are they?
Yeah, so I think that still needs to come out in terms of the interest there. And obviously, look, these are going to be, significant collateralized in terms of what he's ultimately offering from a stock perspective, because that's really what he's doing. I mean, he's leveraging his stock in Tesla to buy Twitter. And I think it's one where it's viewed as a contained risk in the eyes of Tesla holders. I think more of the worry is just if there's a distraction. I think that's sort of overdone here. But I think this all needs to sort of play out in terms of just more details on the financing piece, specifically the equity financing, because that's the biggest worry in terms of could that be another sluggish stock.
Well, Dan, if it can close, how it's structured, I think, is critical to how it operates, because a lot of people are talking about whether this is going to be a for-profit business or a multi-billion-dollar moral crusade. If we're going to have high interest payments on some of these loans, he's going to struggle to make it the latter, isn't he?
Look, I mean, the whole issue here is he'll be able to pay for it, right? I mean, in terms of he's pledging about 20% of his net worth for Twitter. But it just comes down to the easy part in all context was buying Twitter. The hard part's going to be fixing it, because that's the whole issue. That's why no other white knight came, because anyone that looked at this from a PE or strategic, 54.20, I mean, you have to be drinking a lot of Cabernet or alcohol to pay that. And I think that was the whole issue. That's why ultimately, talk about Taylor and the board. Yeah. Once another white knight didn't come, he laid out the finance and they had to get to the table.
Dan, what does the $4 a doubt in the price tell you right now? In fact, it's a little bit less than that. 50.75 in early trading, 54.20 the offer. What do you make of that spread at the moment?
And that's regulatory, not necessarily antitrust, but this will get pretty close looks within the Beltway as well as Brussels. It's must, so it's always a lightning rod situation. Of course, Twitter, look, it's a tightrope for him, and this is not just any platform. It's definitely going to get more scrutiny. We ultimately believe it does close, but there's still some twists and turns ahead, and I think that's what you're seeing the ARBs play here. That more than the financing is what they're playing.
We know there's some very sensitive people in the C-suite that if we see less censorship on a platform like this one, they're going to be increasingly uncomfortable with advertising on it. Michael Nathanson of MoffettNathanson said this: advertisers will be less willing to spend on Twitter if Elon Musk removes content moderation in order to promote free speech. Is that just going to, Dan, push them even further into a subscription model? And when you sit down with a team, have you modelled what a subscription model would look like? How many users would hang around? How many people would actually pay it?
Yeah, so Nathanson, what he's talking about, that's exactly true. And I think that's something they'll move more to a subscription model, probably $2 to $3 per month. If you even assume they got a third of their subs became paid, assuming there was power users, I mean, revenue could go up 20%, and you'd have a lot more free cash flow subscription. But again, easier on paper than actuality, because in this social media arms race, Twitter, as Ed talked about, the last decade's been a treadmill stock.
You've talked about how this might invite some scrutiny on Tesla, and that's the stock that falls under your coverage, Dan. Jeff Bezos out on Twitter yesterday evening said this: interesting question. Did the Chinese government just gain a bit of leverage over the town square? He went on to say, my own answer to this question is probably not. The more likely outcome in this regard is complexity in China for Tesla rather than censorship at Twitter. But we'll see. Musk is extremely good at navigating this kind of complexity. On the latter point that Jeff makes, Dan, of course, Jeff Bezos is right. Elon Musk has been very, very good at navigating this kind of complexity. Can you run me through point by point the issues that you think this will raise for the company that you cover, Tesla?
Well, I mean, the issues are fundamental. I mean, he puts himself in the firestorm. And from a Tesla perspective, that's not what you wanted to see, right? I mean, because this is really, there's no complementary circles in terms of Tesla and SpaceX. In terms of political firestorm, look, I mean, this is going to be a tightrope, because on both sides of the aisle, not just in the U.S., but globally, then you look at Tesla, obviously the relationship in China, globally, could there be a blowback? Could there be a blowback to SpaceX? I think it's calculated risk. But let's just be clear. As a Tesla investor, you're not jumping for joy when he went after Twitter. That's not what you want to see, because it invites just this sort of category 5 storm in terms of a tornado that ultimately is going to come with owning Twitter.
You're one of the big bulls on the street on that name, though, of 1,400, your price target. Dan, is there anything in this that makes you question that 1,400? Anything at all?
For now, no, because I ultimately, it's a contained distraction. I think Musk really, sole focus continues to be Tesla, and we don't worry about that. It's the fundamental story. But any tripping over the shoelace, any stumble will clearly be magnified in terms of, is he taking the eye off the ball? And that's something that really comes to the territory over the next 6, 9, 12 to 18 months when you're trying to turn around Twitter, which is going to be a Kilimanjaro-like climb.
Dan, final word, buddy. A little bit later, we'll hear from Microsoft and Alphabet. If you had to pick one, which one do you like the most right now?
Microsoft Cloud, that continues to be robust in terms of digital transformation. Microsoft's the cloud behemoth. I think that continues to steer tech higher.
Both those names have had a terrible month through April. Dan Ives, thank you, buddy. As always, from Wedbush. On Twitter, on the earnings coming up a little bit later. Coming up on this programme, European banks getting a boost from tighter central bank policy.
The markets, that was a really good quarter, as you know, a record quarter. It's just that the equity capital markets side dried up because of the uncertainty in the markets.
They are hoping for rate hikes from the ECB across Europe. That conversation up next.
We are quite optimistic even, beyond 22, 23, 24 on the back of these much higher rates.
We've said that we want to get back to double-digit returns next year. We're very confident in getting back there. We're very optimistic about the outlook over the next 12 to 18 months.
The biggest second round effect will continue to be a pressure on commodity prices, which may cause a further need for central banks to curb that inflation.
European banks hoping for something that we haven't seen in more than a decade from the ECB, a rate hike. The UBS CEO, Ralph Hamers, saying the following: rising rates will absolutely help our net interest income. Will they get it anytime soon? Taking a look. Here's Taylor Riggs.
And John, at least from the UBS perspective, things looking a little bit better than expected, coming in on some higher trading revenue, at least given perhaps some of the uncertainty and the volatility from Russia's war in Ukraine. So UBS, of course, on the trading side, benefiting from that. Santander is, though, a different story. Citi analysts coming out and saying that this stock is not an automatic buy rating. They've no capital improvements for the year, and there's still a lot of concerns about the economic weakness in Europe. HSBC also a similar story in saying that more buybacks are actually unlikely. They had a 25% drop in adjusted pre-tax profit. But that switches here to the U.S., which is actually a little bit of a different story, but still a big focus here on supply chains. 3M caught off guard by higher expenses. GE looking at supply chain issues. Raytheon cutting the forecast. Polaris, of course, blaming all that first quarter weakness on supply chain issues. If you don't hear the theme in my voice, John, then I could repeat supply chain one more time. Finally, though, of course, what this means is when we think about expenses, how it impacts the bottom line. I know that all the work out of BI, Gina Martin Adams, has done a lot of work on some of that top line revenue, but can these companies pass those costs down to the bottom line? This is where that operating margin, some concerns here of peaking, how you sort of keep up, maybe even expand some of those operating margins in this environment.
Taylor Riggs, looking forward to your coverage a little bit later after the close of Big Tech reporting earnings. A little bit later after the close, we hear from Alphabet and Microsoft, tomorrow Facebook, then on to Thursday, Amazon and Apple. As we said a little bit earlier in this program, those 5 names responsible for 40% of the weighting on the NASDAQ 100. The NASDAQ 100 this year to date, has struggled month to date, struggled in a big way as well. In Europe, things get weird for the banks in Europe. If I told you year to date that we'd have a move of 70, 75 basis points to the front end of the German curve, would you say the financials, the banks on the stock 600 would be down by more than 9%? That's the story. And that's the struggle in the FX market as well. We're looking at central banks hike interest rates with a really, really tough inflation backdrop against a softer growth backdrop. And for that reason, what you're seeing is the banks trade lower in Europe, the currency struggle, and you see a similar story over in the UK as well, with that sterling weakness coming through, that clean break of 130 on cable. Joining us now, Emily Hill of Bowersock Capital Advisors. She joins us on the equity story through the day ahead. Emily, I want to start with your big theme, and that's slowing growth and more prolonged inflation. How does that shape up your outlook?
Well, as I think I mentioned to you before, I think there have been a very powerful force that has been keeping a lid on inflation for the last several decades. And the primary one, or one of the primary ones, has been globalization. And what we've seen over the last year, and it's accelerated, in the last 3 months, has been an unraveling of globalization. And so we're going to end up with a situation where every nation needs their own source of supply. We've seen very fractured, very stressed supply chains. And so that deglobalization is inflationary. So that is, I think it's going to make it more difficult for the Fed to bring inflation under control than they might be anticipating. I think they're they're anticipating a challenge as it is.
Deutsche Bank came out with some pretty strong words earlier today, Emily. I'd love your reaction to it. They said there are good reasons to expect inflation will continue to surprise to the upside. We regard it, therefore, as highly likely that the Fed will have to step on the brakes even more firmly and a deeper recession will be needed to bring inflation to heel. Emily, do you agree with that?
I do agree with that. I think the Fed is in a situation where they've got inflation over 5% and they've got unemployment under 4%. And if you look at the last 8 times that happened, there's been a recession each time. Now, there are some differences in the current environment, but I think the Fed is going to have to move aggressively. And I'm obviously not alone in that assumption.
So slower growth, more prolonged inflation, a more aggressive Federal Reserve, the trends that you identify exacerbated by the deglobalization we've seen going into the pandemic and coming out of the pandemic much more so. As you look across those big themes, Emily, what are the companies best positioned to capitalize on those trends?
In a stagflationary environment, your best bet is defensive companies with pricing power. So we like global infrastructure. We like companies like Honeywell, which is, while it's an industrial, is very high quality, has a good balance sheet, has potential to grow due to its focus on ESG, potentials in quantum computing, et cetera. So you want a company that is again defensive and has the ability to raise prices in an inflationary environment.
Given everything you've described, how do you think the bond market's going to perform? If this is going to be the status quo for a while, Emily, what do you think that looks like on the other side of the portfolio? We've been used to decades coming into this particular crisis of inflation remaining low and the bond market in a bull market. And in that environment, it's made sense to have this ballast in the portfolio, and that ballast has been fixed income, Emily. Has that changed at all?
Fixed income has had a terrible 12 months. I mean, this has been one of the worst years for fixed income in 10 years. Look what's happened to U.S. Treasuries. So we have been underweight bonds now for about 1.5 years, if not 2 years. And the problem is the interest rates were so close to the lower bound that it was very difficult for bonds to play their traditional role in portfolios, which is lack of correlation and ballast. So while I certainly am not expecting to cut a fat hog on bonds over the next 2 years, I do think that they're going to return to playing their traditional role in portfolios. And so we have been buying bonds again, beginning very recently. And I think it's going to be important given the volatility that we expect over the next 3 to 6 months at least in global stock markets.
Interesting. Emily Hill, thank you. Thank you very much. On a day where this bond market is rallying and rallying hard, yields are lower, much lower, and the banks are struggling. The banks on the S&P 500 down about a percentage point. So this is a 4th straight day of weakness for the banks on the S&P 500, and a big move on the front end in a quiet period for the Federal Reserve. If you think about the high of the last year on a 2-year, the high was 278.48, and you look at where we're trading right now at 252.13. That was an intraday high, by the way, on a 2-year. Yields are in about 10-11 basis points at the front end on a 2-year and on a 3-year. On a 10-year right now, down 8 basis points. For a 3rd straight session, the Treasury market is rallying. We're down 8 basis points to 174. And all of this going into the Federal Reserve meeting a week tomorrow, looking for a 50 basis point move from this Federal Reserve. The quest is to get back to neutral, whatever the Fed thinks neutral is. And the debate that Wall Street is having is how much further beyond neutral is this Federal Reserve willing to go? How much further beyond neutral does this Fed need to go to help get inflation back down? And when we say get back down, are we talking about getting back down to 2 or getting comfortable with something in and around 3 or maybe even 4? From New York, coming up, the trading diary, your guide into the weekend, and just a massive 3 days for earnings for this NASDAQ 100 and the S&P. Big tech reporting, those reports just around the corner. 25 minutes into the session, some real old school risk aversion here. Equities heading lower, down 1% on the S&P, wiping out the gains of yesterday on the Nasdaq 100. We're down 1.8%. Big day of earnings coming up. The yen is stronger. The Treasury market's rallying. 2s, 10s and 30s. Yields lower, much lower, down 10 basis points at the front end to 252.55. That's a ball steepener there. That's interesting. That's the price action. Here's the trading diary. Big tech, those results coming after the close. Microsoft and Alphabet, then Facebook on Wednesday, Apple, Amazon and Twitter on Thursday. We get a Bank of Japan rate decision a little bit later this week. Another round of initial jobless claims and Q1 GDP. And finally, rounding out the week with a read of consumption and wages coming up a little bit later this week. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.